Good afternoon, Dr. Benedict and my fellow friends. My name is Ivy, and today my team, which consists of Xinyi and Li Wei, will present on the topic managing the risk of self-securitization. The Reserve Bank implements monetary policy and support the smooth functioning of payment system by managing the availability of liquidity in a form of exchange settlement account balance. They also provide liquidity to authorized deposit-taking institutions, also known as ADI, to promote financial stability during financial system stress. Liquidity is provided to entitled counterparties under repurchase agreement, where Reserve Bank lends cash to counterparty and receives security in return as a collateral. Self-securitization are structured pool of mortgage created by ADI specifically offered as a collateral to Reserve Bank. As collateral in the Reserve Bank liquidity facilities, they enable ADIs to transform illiquid asset into cash, enhancing overall liquidity in the banking sector during market stress period. The Reserve Bank accepts self-securitization as collateral in three types of liquidity facilities. First is the committed liquidity facilities known as CLF. What is CLF? CLF is when Reserve Bank lends up to a pre-specified amount against eligible collateral and charge a fee for this commitment. CLF is usually used by ADI to comply with APRA liquidity coverage ratio, in short LCR. The main objective of CLF is to help ADI meet LCR requirement. Without CLF, ADI will need to meet LCR requirement with high quality liquid asset. The next liquidity facilities is open repos, which is to assist the smooth functioning of payment system. They also address the mismatch in timing of payment within a day and support liquidity for 24 hours payment in a new payment platform made after rush hour. Lastly is the term funding facilities, TFF. TFF is established in March during the COVID-19 pandemic. TFF allow ADI to borrow up to a pre-specified allowance for a term of 3 years at 0.25%. This is to help reinforce the benefit of lower cash rate by reducing funding costs of ADI and encourage ADI to support lending to businesses. I'll pass the floor to Li Wei.
Thank you, Ivy. I'd like to share with you is key feature of self-securitization. First, investors that purchase the securities receive income funded by the principal and interest payments from the pool of mortgages. Second, self-securitization are a type of RMBS, and its obvious feature is a distinguishing feature of self-securitization is that not issue from the trust are typically not sold to the public. Third, RMBS are debt securities backed by a pool of residential mortgages. RMBS is a type of self-securitization. Besides, it's organized in hierarchical order of repayment, and it refers to extraction. At last but not least is to maintain its value as existing mortgages are repaid. The ADI regularly adds mortgages to the self-securitization. Next slide is the risk of self-securitization as collateral. The entity must fulfill the specific ability condition. Second, Reserve Bank carefully controls the risk connected with collateral held under repo. Next is they have a few risks under the self-securitization. And first one is the risk is credit risk, is risk of losses, fail to meet its obligation in accordance with agreed terms. Next is liquidity risk. Liquidity risk is Reserve Bank could not sell the collateral in a timely manner. Second, and it without a significant discount to fair value. Next is wrong way risk. Wrong way risk is exposure to a counterparty is adversely correlated with the credit quality. Next is arises when default risk and credit exposure increase together. And operational risk is related to errors in administering self-securitization, and it affects the self-securitization's credit risk and credit rating. Next is the legal risk. Legal risk is quite complex and varies significantly, and it allows the counterparty to change the loan composition and adversely alter the risk without the consent of note holders. And last is the market risk. Market risk can affect an entire market or asset class. And they have possibility that the price of a security held under repo decreases.
How the Reserve Bank manages this risk. The Reserve Bank will implement a number of controls to mitigate the risk. There are three primary controls, which are eligibility criteria, applying margins to collateral value received, and making margin call each day if the collateral value falls. First, if the eligibility criteria, the Reserve Bank assesses each self-securitization before it is eligible to be posted as collateral against published eligibility requirements. Therefore, self-securitization must be rated as AAA, so that this shows that there is a low risk of loss to note holders, even under scenario of significant stress. The requirement of rating is more burden that Reserve Bank applies to some other eligible securities such as bank bonds and corporate bonds, which they only require to have a minimum rating of BBB. Next, it must be highly structured. The RMBS can be set up with complicated structural features or triggers often to suit the preferences of potential investors. The Reserve Bank expects the self-securitization to be uncomplicated, so the risks are simple to evaluate. Moreover, the Reserve Bank do not accept synthetic asset, where the asset in the self-securitization are derivatives or notes in the other RMBS. Third, it must have no restriction on trading. Although self-securitization are not publicly traded, the self-securitization must have no restriction on trading. This would allow the Reserve Bank to sell the note if counterparty defaults. The other way Reserve Bank manages this risk is by using the margin to protect itself against the changes in the value of collateral held under repo. The Reserve Bank lends an amount of cash that is lower than the value of collateral presented by the counterparty. For a typical self-securitization, the sum of the additional margins can be at least as large as the base margin, such as the collection account provider. It holds principal and interest payment from borrowers before they are paid to note holders. If the counterparty is also the collection account provider, then those funds may not be available to self-securitization if the counterparty defaults. Therefore, the Reserve Bank applies an additional margin equal to the balance of the collection account. This will reduce a key source of wrong way risk. Next, for no market price, the Reserve Bank applies an additional margin because it must rely on model price to value the notes in a self-securitization. As for swaps and liquidity facilities, in the event, if the counterparty default, alternative providers of this facility would be required to ensure risk continue to be managed in a timely manner, and it may be costly too. The last way Reserve Bank manages this risk is having the margin call. If the collateral value falls below a certain threshold, the Reserve Bank will call for additional collateral from the counterparty. The counterparty can meet a margin call by providing more notes issued from the self-securitization. For self-securitization, changes in collateral value are generally driven by changes in the margin and the mortgage pool. Changes in margin may arise due to changes in collection account balance. Changes in mortgage pool may arise due to principal payment from borrowers. Fluctuation in model price can also have an impact on the value of collateral. Although in the short term, this is not the case as molded prices have been frozen for eligible self-securitization until early 2023. In conclusion, self-securitization are an essential part of Reserve Bank collateral framework. The Reserve Bank commitment is to accept these assets as collateral under its liquidity facilities is an effective way of enhancing overall financial system liquidity. The Reserve Bank implements a suite of control to mitigate risk to its balance sheet arising from accepting self-securitization as collateral. A significant component of the risk management process is the requirement by Reserve Bank for issuers to submit the detailed loan level and deal level data on a monthly basis. These data are used to model the risk of the securities value, the securities in the absence of traded prices, and assign margins to the securities. That's all from us. Thank you.